Liquidity explained simply. So now that we understand ownership, control, custody, we need to talk about something that quietly powers all financial systems: liquidity. It's one of those concepts that sounds technical, but it's actually really quite simple. What liquidity actually means. Liquidity means how easily something can be converted into something else without significantly affecting its price. That's it. Liquidity is about speed, ease, and minimal disruption. It's not about how valuable something is, it's about how easily it moves. Everyday examples. Cash is highly liquid. You can use it immediately. No negotiation, no waiting, no price discussion. You hand it over, transaction complete. Property is far less liquid. If you want to sell a house, you list it, you wait for buyers, you negotiate, you handle paperwork, and while you wait, the market may move. The house might be valuable, but it's not liquid. Liquidity is about access and speed, not importance. The marketplace analogy. Imagine you're in a busy market. There are hundreds of buyers and sellers for apples. You can sell instantly at a predictable price. That's high liquidity. If you're selling a rare antique clock, you may need to find a specialist buyer. That's low liquidity. More participants usually means more liquidity. Fewer participants usually means more friction. Why liquidity matters? Liquidity matters because it enables transactions, stabilises markets, allows people to enter and exit positions, reduces friction. Without liquidity, prices swing more dramatically, trades fail, markets seize up. We've seen this in the stock market, property markets, currency markets, and blockchain systems. Liquidity is what allows movement. Without it, systems become rigid. Liquidity versus volatility. Low liquidity often leads to larger price swings, higher risk, unreliable pricing. If only a few buyers exist, a single large sale can push the price sharply downwards. High liquidity tends to smooth price movement, reduce slippage, improve pricing reliability. It doesn't remove risk, but it just changes the shape of it. Think of it like driving on a narrow road versus a multi-lane highway. On a narrow road, one obstacle causes major disruption. On a wide highway, traffic absorbs shocks more smoothly. Liquidity widens the road. Liquidity in traditional systems. In traditional finance, liquidity is often invisible. Banks provide liquidity, market makers provide liquidity, and central banks step in during crises. You rarely think about it until it disappears. During financial stress, liquidity can dry up really quickly. And when that happens, even fundamentally strong assets can struggle to trade smoothly. So liquidity isn't noticed when it's working, it's noticed when it isn't. Liquidity in blockchain systems. Blockchain systems approach liquidity differently. Instead of central banks or large institutions providing it, liquidity is often provided by users through shared pools, through automated rules, and through transparent protocols. The structure is different, but the principle is the same. Markets require participants willing to trade. Without participants, there's no liquidity. Why liquidity is a design choice. Liquidity doesn't magically appear. It must be incentivized, structured, managed. Poor liquidity design can lead to fragile systems, sudden price crashes, and loss of confidence. But strong liquidity design can create resilience, reliable pricing, smoother movement. Whether traditional or blockchain based, liquidity is engineered. It's part of the system's architecture. Liquidity is not value. It's important to separate liquidity from worth. Something can be extremely valuable but illiquid. Something can be modest in value but highly liquid. Liquidity measures ease of exchange, not intrinsic importance. Key mental mode. If you remember one thing from this section, remember this. Liquidity is the oil in the engine. You don't notice it when it's there. You absolutely notice it when it's gone. Markets don't fail because assets exist. They fail when assets cannot move. And movement requires liquidity. Transition to real-world application. Now we understand liquidity, how easy value can move. The next question becomes, where is blockchain actually being used in the real world? Because understanding structure is one thing, seeing practical application is another. In the next module, we'll explore real world use cases and separate infrastructure from speculation.